The last three breaks in global funding markets, moments of acute counterparty stress that preceded major cross-asset volatility, were all signaled when the FRA-OIS spread crossed a threshold of 35 basis points. Last week, this spread touched 41 basis points. This obscure metric, which measures the difference between expected interbank funding costs, forward rate agreements, and central bank policy expectations, overnight index swaps, is the crucial fever gauge of the financial system's hidden plumbing. If you seek to understand why certain physical assets suddenly jump from underpriced to inaccessible, ignoring the mechanics of financial scarcity is a fundamental error. If the financial system's plumbing breaks down, capital seeks refuge in assets it can trust, and that's why we created Finance Saga, to analyze the hidden mechanisms driving market cycles. The apparent surge in demand for assets like silver is not just about industrial consumption or even simple inflation. It is the inevitable physical climax of a prolonged crisis in the monetary transmission system itself. The core thesis here is a structural paradox. Periods of extreme monetary liquidity often create an acute shortage of the one thing the financial system relies upon: quality collateral. Central bank easing, while intended to inject cash and lower interest rates, also expands balance sheets and incentivizes private actors to take on duration risk. This process creates a self-reinforcing cycle of leverage that requires ever-increasing amounts of high-quality assets, like US Treasuries, to grease the wheels of derivatives and repurchase agreements, known as repos. When that collateral becomes scarce, the cost of leverage spikes, volatility explodes, and capital aggressively shifts from financial promises, derivatives, leverage, to physical reality, hard assets. This mechanism, which we will map out 3 times across this analysis, operates in 3 sequential boxes: liquidity injection to right arrow, collateral leverage cycle to right arrow, cross-asset volatility. The first box, liquidity injection, is the starting gun. When the Federal Reserve or the European Central Bank expands its balance sheet or holds rates near zero for too long, it pushes cash into the system. But this cash doesn't just sit there. It chases yield, often through financial intermediaries, large banks, pension funds, and hedge funds, that act as the second box, the collateral leverage cycle. These intermediaries maximize returns by using the low cost of money to run complex, interconnected trades, many of which rely on the practice of rehypothecation, where securities posted as collateral are reused as collateral for new trades, amplifying the financial system's footprint far beyond its tangible base. The pressure from this financial mechanism is why focusing solely on physical mine production is insufficient to understand price action. Yes, the physical demand for silver in photovoltaics, electric vehicles, and AI data centers is creating a structural deficit. This is a crucial precondition, but it is not the driver of parabolic moves. The driver is the monetary policy that has inflated the nominal value of financial assets to such an extreme degree that when the system wobbles, the capital seeking to hedge against that instability is vast enough to consume entire years of physical supply instantly. A key gauge of the stress this leverage cycle creates is the term premium, which we define as the additional yield investors demand for holding a longer-dated bond, say a 10-year treasury, versus rolling over a series of short-term bonds for the same period. Historically, a steep positive term, premium signals economic confidence and demand for duration risk. When the term premium approaches zero or turns negative, it signals that investors are deeply uncertain about future economic growth or expect central banks to hold rates down indefinitely to manage systemic debt. This inversion is a classic warning sign of the third box, cross-asset volatility, because it implies a significant duration mismatch across the financial system. If institutions are running massive leverage bets based on the short-term cost of money, and the market suddenly demands zero or negative compensation for holding long-term debt, those leveraged bets become acutely vulnerable to even small rate shocks. The present situation features both a physical scarcity, industrial demand outpacing mine supply, as documented by sources like the Silver Institute, and a growing financial scarcity, evidenced by the spike in the FRA-OIS spread. This combination is historically explosive. We are facing a structural shortage, but we are also simultaneously dealing with the consequences of a decade-long policy experiment. unconventional monetary tools designed to stabilize the financial system after 2008 inadvertently hollowed out the supply of safe, unencumbered assets. When central banks buy trillions in government bonds through quantitative easing, QE, they absorb the collateral needed by the private market, forcing institutions to rely on lower quality or more exotic forms of collateral or worse, to excessively rehypothecate the limited supply available. This financial mechanism explains a crucial open question. Why did the classic warning signal of 2013, the taper tantrum, which saw Treasury yields spike, fail to precede a massive commodity boom? Why did assets like silver, which had peaked in 2011, decline in the face of rising fear? The answer lies in a critical regime shift, the nature of central bank communication and the immediate regulatory response, which stabilized the collateral chain even as rates rose. We will analyze this critical counterexample later, but first, we must establish the historical blueprint for how the mechanism breaks down when unchecked. Two specific historical precedents illustrate the immediate, catastrophic consequences of financial scarcity and the delayed, explosive effect of policy-driven liquidity flows. If you don't grasp the mechanics of 1998, you won't understand the risks in 2025. The key to understanding the current moment is recognizing that the financial system's stress, measured by the spread between expected borrowing costs and policy rates, is merely the mechanism that translates excessive central bank liquidity into explosive commodity price action. We must examine two historical periods that perfectly illustrate the two distinct phases of this mechanism. First, the acute shock to the collateral chain, and second, the slow burn of monetary flow into physical assets. Case A, the 1998 collateral crisis. The clearest example of the collateral leverage cycle breaking down occurred in the autumn of 1998, following the Russian default and the catastrophic failure of the hedge fund, long-term capital management, LTCM. This crisis was not about inflation or industrial demand. It was a pure systemic crisis of financial scarcity. LTCM was leveraged roughly 25-1, running arbitrage strategies that hinged on tiny, persistent mispricings across global fixed-income markets, most famously the basis trade. The basis trade exploits the small spread, or basis, between the price of a cash bond, like a US Treasury, and its corresponding futures contract. LTCM and others would go long the cash bond and short the futures contract, betting the prices would eventually converge. A seemingly low-risk, high-volume strategy requiring massive leverage to generate meaningful returns. When Russia defaulted on its GKO bonds, global counterparty risk assessment instantly inverted. Suddenly, seemingly safe collateral was viewed with suspicion, and every intermediary who had lent to or traded with LTCM demanded more margin, more high-quality collateral to cover their exposure. This demand triggered a violent, forced unwinding of the basis trade across the market. As LTCM was forced to sell its cash bonds and buy back its futures contracts simultaneously, the basis, the small spread they were betting would close, suddenly widened exponentially. This created an acute, paralyzing shortage of high-quality, unencumbered collateral, particularly US Treasuries. The interbank lending market, the heart of the payment system, froze, and the FRA-OIS spread spiked violently. The fear was that the collateral chain, the very bedrock of financial trust, would shatter. The Federal Reserve was forced to engineer a massive, unprecedented private sector bailout to prevent the systemic collapse. The lesson from 1998 is that the funding mechanism, the collateral leverage cycle, can shatter instantly, requiring emergency intervention, and that collateral scarcity can be more destabilizing than liquidity scarcity. Case B, the 2010-2011 policy flow into hard assets. The second historical precedent shows the consequence of that intervention. After the 2008 global financial crisis, the Fed moved aggressively to the first box, liquidity injection, launching multiple rounds of quantitative easing, QE1, QE2, and maintaining near-zero interest rates. The goal was to repair the damage from the 1998-style crisis, but the effect was to flood the system with so much cash that investors were forced into riskier assets to generate any return. As fixed income yields were suppressed to historical lows, the capital became captive. It flowed out of the financial plumbing and into hard assets, driving the cross-asset volatility box to the extreme. The result was the 2010-2011 commodity superspike, where oil, gold, and especially silver saw parabolic moves culminating in silver hitting multi-decade highs. In 2011, the silver price gain was not driven by a sudden leap in solar panel production. It was a direct consequence of sovereign money being printed and then seeking physical refuge. Who benefited in the payment chain during this period? Producers, who could increase mine output quickly, as well as institutional funds and wealthy individuals who had built positions in physical metal before the QE programs began. Who paid? Industrial users who saw their input costs skyrocket, and derivative sellers who were caught short as the paper price decoupled violently from the physical supply. This period demonstrates the full delayed transmission of the mechanism map. Liquidity injection, right arrow collateral leverage cycle, right arrow cross-asset volatility, where QE flooded the system. Asset managers leveraged the cheap money, and the final output was an explosive move in physical commodities. To integrate this historical context with our current problem, let us repeat the mechanism map with more detail. The cycle begins with liquidity injection, policy easing, QE. This fuels the collateral leverage cycle, basis trades, duration mismatch, rehypothecation. The inevitable result is cross-asset volatility, funding stress, parabolic commodity price spikes. The stress point in this cycle is often marked by the term premium, which measures the market's willingness to hold duration, and the basis risk, which measures the potential for paper and physical assets to decouple. The crisis of 1998 illustrates the fragility of the basis trade within the leverage cycle, while the boom of 2011 illustrates the explosive consequence of the liquidity injection phase. But here is a sharp question that separates today's risk from 1998. What structural changes and standing facilities are in place today that make an immediate, paralyzing collateral freeze less likely yet create a new, subtler risk that could still lead to a violent commodity spike? The answer lies in the counterexample of 2013 and the evolution of central bank emergency tools, which we must analyze to accurately gauge the modern threat. The reason the taper tantrum of 2013 is so vital to understand is that it represents the critical counterexample to the two historical precedents we just established. The market interpreted this communication as a sudden withdrawal of support, potentially leading to a 1998-style seizure in the collateral leverage cycle. But a financial crisis did not materialize, and critically, the commodity boom did not resume. Instead, silver and gold prices continued their decline from the 2011 peak. The regime change that neutralized the crisis signal was not an economic improvement, but the aggressive use of forward guidance and targeted regulatory shifts. The Fed's communication, while initially jarring, quickly morphed into a managed exit strategy. Officials repeatedly stressed that tapering asset purchases was not the same as raising interest rates, using precise language to manage expectations and provide financial institutions with a roadmap. Simultaneously, the implementation of post-crisis regulations, particularly the heightened capital requirements under Basel III, pushed banks to hold more high-quality liquid assets, HQLA. While these regulations exacerbated the long-term structural scarcity of collateral by locking it up on bank balance sheets, they dramatically reduced the velocity and risk of the rehypothecation process that amplified the 1998 crisis. By forcing intermediaries to deleverage and hold more capital, the regulatory framework placed a shock absorber within the collateral leverage cycle, preventing the immediate violent unwind that characterized the LTCM failure. This is the difference between a crisis that paralyzes the financial system and one that merely forces a market correction. 2013 showed that the Fed could control the rate of financial deleveraging, even if it could not stop the long-term price distortion. Now, we must apply this historical framework to the present. The current environment features a structural physical scarcity colliding with a system that is still incredibly leveraged, yet operating under new rules. Three key signals warn that the shock absorbers from 2013 may now be overwhelmed by the accumulated leverage and current policy settings. First, the FRA-OIS spread. As defined, This is the measure of bank funding stress. Its current level, near 41 basis points, BPS, is well above the median historical low of 10-15 BPS seen during calm periods. The last time it was consistently this high was during the initial COVID-19 funding panic in 2020. And before that, during the 2011 European sovereign debt crisis. Historically, when the FRA-OIS persists above 40 BPs for more than 3 consecutive weeks, it signals an immediate fear of counterparty failure, a clear breakdown in the collateral leverage cycle box of our map. The median lag time between crossing 40 BPs and a 15% correction in a major equity index or a 20% spike in a commodity index has historically been just 4 to 6 months. Second, the 10-year term premium. The current term premium has recently plunged into negative territory, sitting near 30 basis points. A negative term premium means that investors are actively accepting a lower return to hold long-term bonds, either because they fear a recession, a flight to safety, or because they believe central banks will ultimately force rates lower to service high debt levels. Financial repression. The last time the term premium was consistently this low outside of the great financial crisis was just before the 2000 dot-com bubble burst, signaling deep misgivings about the long-term growth outlook and the sustainability of prevailing asset valuations. In the context of our map, a deeply negative term premium signals the final phase of the liquidity injection box. The monetary policy has run its course and distorted risk pricing to the point where the market refuses to price duration risk accurately. Third, the high-yield option-adjusted spread, HY OAS. This spread measures the extra yield investors demand to hold highly risky corporate bonds over risk-free treasuries, essentially reflecting the default risk baked into the price. The current HY OAS is relatively tight, hovering around 350 basis points. While this is not at crisis levels, it topped 650 BPs in 2020, its direction is crucial. The HY OAS is the final temperature check on the cross-asset volatility box, reflecting general credit conditions. Historically, a tight spread like this is common late in the leverage cycle, just before a sharp reversal. The median lag between the HY OAS crossing a critical warning threshold of 600 BPs and a flight to safety trade, like a significant jump in assets like gold or silver, has been 9 to 12 months. The risk here is not the current level, but the speed at which it can move if the FRA-OIS signal breaks down the financing mechanism. We can finalize our mechanism map by integrating these signals. The cycle starts with liquidity injection, measured by the negative 10-year term premium. This feeds the collateral leverage cycle, whose stress is measured by the spiking FRA-OIS spread. The resulting pressure leads directly to cross-asset volatility, whose severity is measured by the rapidly widening HY OAS. The current signals show that the engine is running on fumes, the stress gauges are flashing red, and the final risk is now purely concentrated in the speed of the unwind. The key is now to quantify the specific thresholds that translate historical warnings into current risk. The convergence of historical precedent and current data demands a definitive, quantified if-then funnel to gauge the immediate risk of a cross-asset volatility event. We are not making predictions, but assessing the probability of a mechanism fulfilling its historical function based on measurable thresholds. This funnel begins with the 3 signals we identified, leading to a probabilistic outcome that bridges the financial crisis, 1998, with the commodity climax, 2011. To formalize the if-then funnel, we have 3 quantified scenarios. First, if the FRA-OIS spread persists above 45 basis points for 4 consecutive weeks, then acute funding stress is confirmed, and a significant deleveraging event typically follows within 6 to 9 months. This scenario suggests the immediate breakdown of the collateral leverage cycle box, forcing asset sales and massive margin calls across the derivatives market. Second, if the 10-year term premium falls below $50 basis points for 8 consecutive weeks, then a deep, policy-driven flight to safety is confirmed, rendering long-duration assets acutely mispriced. This outcome has historically preceded the most aggressive central bank liquidity injections, often resulting in capital aggressively exiting fixed income and entering hard assets, the cross-asset volatility phase. within 12-18 months. Third, if the high-yield option-adjusted spread, HY OAS, crosses 600 basis points for 6 consecutive weeks, then widespread credit distress and default fears are confirmed. This is the clearest signal of system-wide risk aversion, and a major spike in assets perceived as unencumbered safety, like gold and silver, typically follows within 9 to 12 months as capital searches for ultimate refuge outside the banking system. The base case, 65% confidence given current data, suggests a slow-motion unwind where the negative term premium drives financial capital to physical assets over the next year, forcing a price spike in scarce commodities like silver, even if the funding system doesn't immediately shatter. The alternative case, 30% confidence, involves a rapid credit shock, HY OAS crossing 600 BPS, forcing an immediate 1998-style flight to physical safety. The nullifying condition, 5% confidence, is a sudden aggressive move by the Fed to drastically reduce its balance sheet while simultaneously introducing permanent, highly effective standing repo facilities to manage collateral availability, a move which would stabilize the funding mechanism but risk a major equity correction. This process has stark consequences, framing the outcome not as moral judgment, but as a clear shift in cash flows. The ultimate question is, who pays and who benefits when the financial system plumbing breaks down and the scarcity paradox culminates? Who pays will be the highly leveraged financial intermediaries, entities running complex basis trades or highly leveraged futures, forwards positions, e.g., in precious metals or energy, facing immediate margin calls when volatility spikes. Next are the industrial users and manufacturers, companies like solar panel manufacturers or electronic producers whose input costs, silver, copper, skyrocket unexpectedly, squeezing profit margins and demanding higher working capital.